Hello and welcome to Chapter 4, Cost, Volume, Profit, or CVP, Relationships. All right, so this one keeps building, people. We are going to go fast and furious right into looking at the contribution margin statements and then using it in a bunch of different permutations and combinations. In this set of videos, we have a number of learning objectives. In fact, we have 7. So we have 1, 3, and 4, 5, 6, 7, and 8. And if you look here, you'll see a number of things that say compute or explain or determine. So what happens here is it starts kind of like a funnel. We're going to leverage the contribution margin statement and we're going to start turning that into a formula, and then we're going to use that formula in a number of different ways, like I said, permutation and combination, to then answer some questions. So if you are uncertain with what a variable cost is, what a fixed cost is, what a contribution margin is, please go back and watch the videos from chapters 2 and 3. Because we will not be going back into depth into those. Rather, we will be going fast and furious into applying those, starting, and not examinable, 9, 10, and 2. Into learning objective number 1, we are going to be looking at explaining how changes in activity affect contribution margin and operating income. Friendly reminder, cost, volume, profit, or CVP analysis is a powerful tool that managers use to help them understand the interrelationship between cost, volume, and profit. So that is, what do items cost, how much of each of them are we selling, or producing and therefore selling, and then what is their different types of profit by profit line in an organization. So we can understand these interactions by looking at the following 5 elements, and that is, what's the price of our products? How much of those products are we selling? What does it cost us to make? What are our total fixed costs in production? And then what is the mix of products sold? So for example, we might have Volkswagen who has, let's just simplify it. Let's say they have a car, an SUV, and a minivan. I don't think they have a minivan, but let's go with it. How many of each type are they selling? Do they have one fixed cost for each, or do they have total fixed cost, just like one, I don't know, conveyor belt where they make each one of the different types of van, car, and minivan, SUV, minivan, and car. How much does it cost to make each car, minivan, or SUV? And what are we selling each one of them for? Friendly reminder, here is our contribution margin. We start with sales of 500 units. We, in this example, every unit costs $500, and then we have a percentage of sales. So you'll kind of see this format a lot, or you might see elements of this format. So we might only look at total costs. We might look only at per unit costs. We might only look at percentage of sales. So of course, percentage of sales itself is 100%. Then variable expenses, 300 of 500 is 60%. And here we're taking the 500 units times by 500 equals 250. 500 times 300 equals 150. So we get a total contribution margin of $100,000, which equals $200 per unit, or 40% of sales. And then because fixed costs apply to all of these and remain fixed due to the nature of its costs, our fixed expenses are $80,000, and therefore our net operating income is $20,000. So any incremental contribution margin, so if we sell, say, 501 units, then our net operating profit would be 20,200. And that's because any incremental sale will also have incremental variable costs or variable expenses. And therefore, we look at the contribution margin to get that each additional analysis factor. Another way of putting this is looking at this is saying, cool, what is our break-even number? So if we sold 400 units in a month, the company will be operating at a break-even point. So you can see this, 400 units times 500 equals 200,000 minus the variable expenses, which is 400 times 300. And then we have our contribution margin of 80, and our break even is when our contribution margin equals our fixed expenses of $80,000. So another way to say this is if 400 units are sold in a month, then the company will be operating at a break even. So then if 401 units are sold, how much would the net operating income be? Please pause this video and come back and let me know. That is right. If you said $200, you would be correct. If one more unit, 401 total units, is sold, then we flow through. Feel free to math this out on your side. But the quick and dirty math is saying, cool, we had 400 units and they broke even with a contribution margin of 200. Therefore, if we sold one more unit, we'd have an extra contribution margin of 200. Fixed costs stay the same because they are fixed costs. Therefore, our net operating income with a sale of 401 units is going to be $200. Okay, now one more time. What if 430 units are sold? What would the net operating income be? Okay, well, in order to answer that, so if we went from 400 to 430, that would be an incremental units of 30. So then we'd be looking at 30 extra units, make this slightly bigger. And then we know that we have a contribution margin of $200 per unit. Therefore, if we have an extra 30 units times $200 per unit of contribution margin, and we already know that 400 is break even, then our net operating income with 430 units sold would be $6,000. Alrighty. So that's intuitively how this works. Let us go and look at the slides to get some, we're going to start building some formulas. So let's take a look back at our slides. Oh, hello. There we go. All right, so friendly reminder, we have our total dollars, our per unit, and our percentage. This is all of our contribution statement approach, contribution margin approach. We're going to start formalizing these. So here's a visual, then intuitively how it worked, each incremental unit, and now we'll start building some formulas. So the contribution margin ratio is the total contribution margin divided by the total number of sales. And so we saw that right here. So now we're just formalizing these two rows in the previous slide. So if we're looking at it as a ratio, we take the total contribution margin divided by the total number of sales. That gives us the far most right-hand column. And then if we look at it as far as the number of units, we can look at the unit contribution margin divided by the unit selling price in order to get us the contribution margin there. Okay, let's take an example and actually, we can either do this one together or you can take a shot at it and see how you do and then go from there. So completely up to you, because we are looking at coffee clutch. We're going to see this example a fair amount, so I'm not going to read it to you each time, but rather pause the video and either attempt it or pause the video, read this, and then come back and we'll go through this together. Thank you so much. All right, so let's go through this one together. All right, so I've set up this in Excel. Feel free, the slides are linked below. You'll see that they're organized by tabs. So we are lecture 1, slide 12 right now. All right, so we know one of these is our correct answer. If you want to give it a go on your own, feel free to do that. But right now, we're going to do this together. So let's look at what our CM ratio is. Our CM ratio, why aren't you clicking? Ah, there we go. Our CM ratio is going to equal our total CM divided by our total sales, or our CM divided by sales. So we can, because we have total on both, we can just look at individually what each cost is. So our CM on the numerator is going to equal our average selling cup of coffee is $4, and our variable expenses per cup is $1. So our contribution margin is 3, and then divided by our sales is 4. So let's make this a little bit more aesthetically. No marks for pretty, but we're learning, so let's at least have some proper format here. So our CM is going to be 3 divided by 4. Our CM ratio is going to be 3 divided by 4, which it gives us 75.75, or B, 75%. Going back to the slides. If you picked B, you would have the correct answer. So you're going to see that as we go through subsequent slides, it's going to be same, but different. So different formulas, all using the CM ratio, or a version using the CM ratio, and applying. The trick will be to do enough practice so that you can understand, where do I use the information? What if I'm given, for example, operating income in the CM, but I'm not given fixed expenses? You'll have to solve for that. So a student once asked me a long time ago, I have a podcast on this. If you want to hear Kate and I recount this, feel free to listen to my podcast with Kate. But essentially, she asked me, when she was in first year, she is now at the London School of Economics, and doing a double degree master's at U of T. She asked me, what will we have a formula sheet on this? And the answer is no. And the reason for it is the formula sheet is literally sales less variable cost equals contribution margin less fixed cost equals operating income. At the time that she was in my class, I think Kate would tell you that she wasn't the strongest student, both in my class and then in subsequent classes. However, at some point, she just kept working, as well as, asking things like, where's the spread? Where's the, she wouldn't say where's the spreadsheet. She's like, where's the cheat sheet? And I'm like, this is not, anyways, there was some not colorful language, but like definitely some expressive language used by both of us. And here is the formula. And then there's different permutations and combinations. So while Kate would say that this wasn't necessarily her favorite class, and she did end up not being an accounting major, which again is okay, we stayed in touch throughout the years, and I've got to be a little part of her journey, and where she's been able to take herself has been really cool. So I say all of this, that if you're like, this stuff isn't easy, I would say I agree. But it is not a sentence. It does not doom you to not being an accounting major or being an accounting major. It doesn't doom you to never understanding this, because I will say Kate started off not necessarily, having this be intuitive, and it ended up, she had a relatively solid mark coming out of this course. And then, your first year doesn't kind of condemn you to your second year, doesn't condemn you to anything, right? You choose the effort that you put in, you choose the amount of office hours that you come to see, you choose the amount of discussion board posts or practice problems that you want to do, and you choose where you eventually will take yourself, whether it's in this class or in the next or in subsequent years. So all that to say is thank you so much for your attention in this video, and I will see you in the next.